Good afternoon, everyone. It's Monday, the 29th of January. Can't believe January is almost over. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities, and welcome to our latest edition of Market Mondays. ASEAN markets have been treading water most of last week, looking for some direction on when US rates cuts are going to come through versus when will the bottom be for the Chinese market. So there's a lot of uncertainty around there, but we're going to make some sense out of it all. First up, we're going to talk about Singapore inflation. Um, Inflation actually started to show a little bit of acceleration in December, and we also saw some manufacturing numbers coming down as well. So, what does that all mean? I actually spoke to Dr. Hagbin Chua, and we're going to bring you that. After that, Singapore REIT results have started to trickle through. What are the early signs showing? I'll have a special comment on that. And then finally, we also have a brand new initiation coming out of our Thailand office, TTW, which is a water play. We've got our analyst on the line to take us through that. So do stick till the end. But let's start with the market moves for last week. We did see some profit taking and some weakness coming through to the S&P as well as the Nasdaq last week, largely coming from some of the tech company results. Intel was a little bit weak. Tesla also was quite weak, so there was some money being taken off the table there. We did see Japan also coming off a little bit again. I think market taking a breather after some very, very heady start to the year. I think one of the bigger disappointments was the HSI, which was down about 1.6%, largely continuing on the anticipation of the slower Chinese property market. We did see Evergrande, a judge issuing an order for Evergrande to be liquidated. So that's going to have some increased uncertainty and ripples across the financial markets in China. And overall in Southeast Asia, we did see some positive moves on the STI as well as the KLCI, partly from expectations of rates and particularly the banks moving, but generally a weakness on the SCT as well as in Jakarta. Now, let's move to the macro side and let's talk about the Singapore economy. MAS kept its overall policy on pad today, didn't and continuing to drive the Singapore dollar to appreciate. So we have. I actually spoke to Hagbin Chua earlier on what he thinks. So let's watch that video. Can we play Hagbin's video? I mean, December inflation readings show an acceleration even before the GST and the carbon tax hikes. Yet the MAS stayed pat today and maintained their Sing dollar appreciation stance. What does this mean for inflation going forward?
So I think this disinflation process has come to a halt, and we've had a quite nice glide in inflation throughout most of the year, but suddenly there's this uptick in December. So it seems that the exchange rate is helping to contain some imported inflation, but the services inflation, which is dependent on wage costs and all that, that's still a bit sticky. So we're expecting the MES to maintain this current appreciation bias. Well, they did for today's meeting, but also at the April as well as the July meeting. I think I think until they're a lot more comfortable that core inflation starts stepping down, hopefully by the fourth quarter, then I think there's a chance that the slope of the appreciation bias will be reduced.
Okay. And so Singapore's December NOTEX was weak, and now we see manufacturing also saw some declines. How concerning is this, and what does this imply for growth this year?
Yeah, so we thought that the manufacturing would be a cleaner gauge of the state of the overall electronics demand and so on, because the NOTEX for December did correct. But it could have been affected by the Red Sea crisis as well as the drought in the Panama Canal. So unfortunately, manufacturing fell, but it was largely due to the volatile biomedical segment, because that sector actually plunged by 24%. That's pretty volatile. It goes up and down, and it's almost impossible to forecast. But when you look at electronics manufacturing for December, it actually grew 6.3%. So it actually accelerated from the 5.1% in November. So I think that's encouraging. It does suggest and is consistent with some of the PMI numbers we've seen for Singapore. For overall as well as electronics, it's essentially up for 4 consecutive months. It's also consistent with some of the numbers that we've seen for sort of Asian export-reliant economies. So I think the electronics part is still going to recover and support growth this year, which will be quite important, because for the first 9 months of last year, manufacturing subtracted from growth. So we're maintaining our view that the economy will accelerate to about 2.2% in 2024.
Okay, so that was Hak Bin talking about Singapore's macro. We do continue to expect to see an acceleration in growth for Singapore going forward. Now, let's turn to some stock at this point, and the REIT sector. We've had some early REIT results coming through, and generally the results have been fairly downcast. Mapletree Logistics Trust, they saw third quarter DPU for FY24 falling 0.7% quarter on quarter. There was organic growth from existing assets as well as contributions from a lot of their recent M&A, but this was offset from higher borrowing costs and as well as weak FX. The Sing dollar has been extremely strong, as well as lower income coming from China as well. Krishna has downgraded this stock mostly on sluggish Chinese growth. However, he has raised the target price to $1.70 from around $1.60, taking into account a lower discount rate. I think what you will see across the street for a lot of for a lot of the REITs in Singapore will be that the discount rates that the dividends get discounted on will start to be reduced, mostly on anticipation that interest rates will start to go down this year. The other stock was SUNTEC REIT. Fully dividends per unit actually fell about 20%. Interestingly, Singapore's performance did pretty well with better revenues coming from Suntec City retail, office, as well as on the convention side as well. However, this was more than offset from higher expenses, weaker Australian dollar, as well as the Australian operations. So Krishna has lowered his DPU estimates on this stock, but again, marginally increased his target price to $1.20 from $1.15, and he's maintaining hold on this. Now, this is just 2 results versus the entire sector. We actually think that, this doesn't take away from our thesis that this year is going to be a good year for overall S-REITs, but you need to be selective on which REITs that you that you go overweight on, or the which REITs that you buy. We think that generally look for the good quality, large cap and high liquidity names. For a lot of them, valuations are actually quite compelling, especially now with the 10-year Singapore yields. Government yields are down below 3%. So I think the dividend yields that some of the big cap names are giving are becoming more and more compelling. So especially if we go into a rate cut scenario, Singapore looks extremely attractive, and the S-REITs will be amongst the top sector there that can re-rate. Just to remind you what our top picks are for this sector is CapitaLand Ascendas REIT, CICT, as well as Lendlease Global Trust L-REIT. So do have a look at those names as we go forward. Now, With the REITs, let's take a pause and go to Thailand. And Thailand last year was not one of the better performing markets, but at the same time, we think this year, from a strategy point of view, this market has a lot of promise. There's a significant amount of government spending that is expected to come through this year. Valuations are quite cheap. A lot of the foreigners who wanted to sell the market has already sold out of the market. So I think, the risks are on the upside. And within that, we've got a new stock that we've just initiated on TTW, and we have Nachapon online to take us through it. Nachapon, welcome to the show.
Hi. Uh, on TTW, we initiate coverage with a buy rating and a target price of 10 baht. Uh, the main business is produce and sell tap water to the Provincial Water Works Authority or PWA, which is a state-owned company under the two concession and two areas. The two major areas that the company operates is western part of Bangkok, uh, which is the main part of the TTW that PPW operate on their own in the western part of Bangkok. Another part is northern part of Bangkok, operated by its subsidiary named PTW. PTW. The to have the concession right and the quantity is depend on the demand on each area and the price that selling to the state owned is adjusted annually by inflation. That's the main business for PTW. But in the past 2 years, if you see the share price is come down from about 14 or 13 baht to nowadays about 9 baht. There is a market concern on PTW concession that expired last October. Reading a concern that the company will cannot maintain dividend payment at the same rate. However, I think I think uh to as of now the concession of PTW has already expired, but PTW raise the asset back to the company and operate the same operation, but the term of operation will decrease as average selling price to the state-owned company will reduce by 50%, right? Yeah.
Mm-hmm.
So the earning of TTW has surely declined. However, our calculation does expect the company to maintain the dividend payment at the same level at 0.6 baht per share, despite the reduced selling price. This is partially offset by the absence of asset depreciation and reasonable cost of leasing back the asset. So therefore, we forecast the dividend yield for the TTW is at least 6.4% for the next 10 years annually. Additional, there is another positive factor that the peak in the bond yield is expected that the Fed will cut policy rate multiple times this year, and including potential reduction in the Thailand policy interest rates. This tends suggests a downward movement in the bond yield, which benefits TTW due to its high negative correlation with the bond yield. In summary, we believe that the 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 northern part of operation will not significantly impact the annual dividend payment with expected annual dividend yield of 6.4%. We recommend buy with a target price of 10 baht.
Thanks,
Yeah, I
Nachapon.
yeah the reason that why I like this stock, the two main reason that I think the share price is the market has to punish the share price that's come down from about 14 13 to around 9 baht. I think this share price level is provide is offer attractive dividend yield for at least next 10 years. The key risk for the TTW is in 2000 uh 2034 that the main concession of the western part of TTW will be expired. That the key risk that I don't know what happened, but TTW will negotiate with the state-owned company in the next 10 years.
Got it. So very clear sort of dividends for the next 10 years. The market has sold this stock down. So there is very attractive yield. Interest rates have peaked. So there is that potential for some upside re-rating of the stock as well. So quite an exciting story at this stage. So please do have a look at TTW. Thanks, Nachapon, for joining us today.
Thank you.
Just want to remind you that we do have a very special Thai macro outlook webinar that is happening on the 1st of February. So do sign up for that. If you will have the entire Thai research team giving you their top picks as well as the outlook for the year as well. There is a question here from Chris Tan who's asking if inflation remains persistent or even starts to accelerate, what stocks should I have in my portfolio in that environment? I think that's a very good and timely question. I think if you look at the sort of components of inflation that is kind of rising, we do see high energy costs, and specifically for Singapore, you have a tight labor market as well. And one of the key factors is if inflation continues to remain high, is that you may have delays in when interest rates actually get cut, Chris. So in such a scenario, I think one of the key sectors that you do need to look at is the banks. The banks generally tend to benefit when interest rates are high because they can actually drive higher margins, and they don't get impacted on the cost side as much. So you might, so the banks, particularly DBS, UOB, and OCBC, should all benefit if interest rates remain high because of inflation. The other area to kind of look at would be if you have higher energy costs, and that should feed into some of the industrial names like Sembcorp Industries and Keppel, especially because they're going into alternative energy, plus they're in utilities. So again, they might benefit from that, particularly if they can pass on some of those higher costs on to the consumers, which we have seen them doing in the past as well. And finally, I think if you look at a small cap, it might be a name like HRNet. Given the sort of tight labor conditions in Singapore, companies like that might benefit from more placements and so on. So I hope that gives some clarity. Let's quickly, jump on to technicals. Nick, our chart guy, has got two stocks that he is highlighting today. CIVMEC, if you remember, CIVMEC is one of our Opportunity Plus high conviction picks. Nick thinks that the current sort of the setback that the stock saw in the last few weeks will start to turn around, and momentum will be back on that stock. The next stock that he's highlighting is RIVERSTONE, the glove maker. He thinks that the positive momentum that the stock has had over the past few weeks will continue. So do have a look at what he's saying on the newsletter. Let's quickly turn to our upcoming dates. and events. We've got quite a lot of results coming through. It's the peak of results season. So make sure that you are getting our daily newsletter as well, not just the Monday newsletter, because that highlights a lot of the overnight movements when it comes to results. We've got Keppel Trust coming out on the 30th of January, Singapore Exchange reporting on the 1st of February. Lendlease, one of our top picks, also reporting on the 1st of February. So please do keep a watch out for that. In terms of other events, as I mentioned, we have the Thai Macro Outlook Day, which is on the 1st of February. And we have a very special, for those of you who missed Feng Shui seminar at last week, you have another chance to see Master Ken in action and listen to his forecast on the 5th of February. Do ask your salesperson on how you can join for that. And then we also have a very special webinar on China with some very senior, with a very senior academic talking about the direction of China. So do speak to your salesperson again if you like to join for that event as well. Now with that, we're out of time. Thank you so much for joining us today. And please do join us next week, and please do let your colleagues, your friends, and your investors know that this is a completely free seminar. So everyone is welcome to join, and have a profitable trading week. Thank you.